continuation of our class today, we are going to be driving in like what are the things you can buy at the money market. So it is very, very important for you to know things and categories of things you can buy at the money market. Like have explained, that the market is a place for buying, but there are some specific things you can buy at this kind of market. Even I'm in Lagos, Nigeria. There are some market that is well known for a particular thing. If you want to buy clothes now, they can tell you that, oh, go to this so market. You can get a kind of, no matter the kind of clothes you are looking for, you can get it there. So if you want to buy shoe, there are some market that is purposely because of that. Not that they don't sell any other thing, but that is what the market is known for. The same thing applicable here. So when we are talking about the money market, there are some things that you can buy. So here I said in Nigerian money market, you can buy shares, bonds, treasury bills, mutual funds, and each investment over levels of risk, income, and potential growth. Like I always tell people, there is no investment you are driving into without its risk attached to it. So it is very paramount for you as an investor to identify and know the kind of risk that is attached to the investment you are going for. You get that? So the thing about the money market is that the reason why we have this different categories of investment is because it is not good for you to put your egg in one basket. So, and there's something called diversification of portfolio. So it is good for you to have different categories of portfolio, and the reason for that is still part of the reason is for you to mitigate risk that is attached to your investment. Today, like I said, what you can buy, one of it is shares, second is bonds, and third is mutual fund. I'm going to explain all these things and how it works. I said understand how shares work. So we want to examine how shares work from different company. Now, like I put here that a company share represents ownership in a company. That means a company is giving you a right to own part of their company. Let us assume that a company has 100 million 100 million naira. I'm in Nigeria. So a company has 100 million naira, and you are given a privilege to buy like let's say 10 million. That means that you have 10% ownership in that business. That's the interpretation. So when you buy shares, you become a part owner. That means you are called a shareholder. That means that you are part of those that contribute to the success of this company. And one of the things that company use your money for is their own development. Like now, there are some things they want to do that when it comes to finance or funds, they are not capable. But because there are some group of people that comes together to, it's like you loaning a company and owning parts of that company. So that is what shares is. So you owning a shares in a particular company, it's giving you an ownership in that company. No matter how small, big, or large that shares or the amount of shares you have in that company might be. So even if you have one shares in a company, you are still part of the ownership of that company. Now, the question now is that, is it every company that you can get these stocks? The answer is no. It is not all the company, because at the end of this teaching or training, you are going to know the categories, different companies that you can buy the shares, and we are going to explore all those things together. But I want to firstly tell you now that it is not all the company that you can get their shares out there. And why is it like that? According to the regulation, any company that is you are seeing maybe limited, uh, that is called limited liability company. That kind of company, one, you cannot buy their company, and the reason is because they are not yet public. That means the decisions and every information pertains to this company can be within the organization. They are not mandated to share any of their information out there except they wish. So, well, when it comes to PLC, that is public limited company, so they are mandated in order to share every of their information out there, most especially their financial report. So, and that is the reason why you will see most of the company, you can get access to their financial report as at every periodic time. The reason for that is because they are mandated. Me as an investor, right? I invest my money into their business, so it is mandated for them to tell me their financial what's it called, their financial strength and where they are financially. So, and that is one of the reasons they pull out most of this their information to the public. You know why? Because they are called public limited company. So it is only this kind of company that you have access to buy their shares. So it is not all company that you can get their shares from. It is only company that is bearing PLC at the back of their name. That is the company you can have access to buy their shares. I don't know if I'm communicating. Now, like I said, that for every investment, there is always a benefit that is attached to every investment. But in these years that we are examining together, what are the how will I put it? What are the benefits that is attached to buying a company shares? And in this, at the course of this teaching or training, we are going to be examining three benefits that is apportioned to you buying a shares in a company. And one of it is what we call capital appreciation. Yes. How does capital appreciation work? I'm going to explain that to you. Let us assume that at the time you want to buy ABC, um, you want to buy ABC PLC shares now. As at that time, let us assume that ABC PLC, what their one shares is 1 naira per share. Assumption now, you want to buy ABC Limited, but their one shares is 1 naira per shares. So what you are saying now is that let's now assume that you get these shares as of January 1st, 2025, right? But after 3 months, you go back to examine your stocks and you discover now that ABC PLC is now selling at the rate of 3 naira per shares. What has happened to your share is what we call capital appreciation. Now, let's now assume that you have let assume you have 10 shares. Don't forget that you bought one share at the rate of 1 naira. That means your total money is 10 naira when you are buying it, right? But now you are the company said that they are selling now at the time you check at the rate of 3 naira. So that your total 10 shares that you have, if you multiply 10 shares multiply by 3 naira, that gives you 30 naira. So at the course of this period, you've gained the total amount of 20 naira. That is what we call capital appreciation. And this is what happens most of the time at the stock market. Yes, the stock can goes up, rise up. The stock can also reduce when it comes to its value. So, but one of the things you enjoy as a shareholder is that there is what we call capital appreciation, which means increase in the value of the shares over time. When a company performs well, its shares price rises, allow investor to sell at a profit. You see that? So it allow you as an investor to what? To have your profit over time. Another things you can get or as a reward as a shareholder is what we call dividends. Dividend. How does dividends work? This is one of the things that I enjoy. And you must, for you buying any shares, please try as much as possible to know why you are buying the shares. Some people are buying shares because of capital appreciation, like I've explained. Some buy shares because of their dividends, right? And the third, which I'm still going to explain, how does dividend work? Dividend works as a result of, like I was explaining what shares is all about, that is as a result of you giving your own money to a company to run their activities, right? Now, at the end of all their what's it called, all their financial year at the end of each year, right? So the company now declared a profit of let us assume 100 naira, right? The company declare a total profit of 100 naira. So when they have their own general meeting, which is going to be public, also they call for general meeting, um, they now sit on the board of director. Oh, what percentage are we giving out, and what percentage are we retaining? That retain, there's something we call retaining. Is as a result of um, retaining some certain percentage of their profit in order to reinvest that money into the business. So you can't hit all your profit, your company will die. Yes. Yeah. So as a result of this, the board of directors sits and they have meeting on, okay, this total amount of 100 naira that we make, they can decide to say, okay, let's do it 70-30. That means if they are doing 70-30, that means that 70 naira can be apportioned to the shareholders and 30 naira can be apportioned to their retained earning. Like I've explained, that retained earning happens because they want to invest that money. Now, if that happens, now they've gotten, or they've taken a decision of sharing 70 naira. So 70 naira is now going to be calculated based on the total number of shares that the company has. Let assume, I like I like giving much of illustration for you to understand it very well. Let assume that a company has 200 shares. That is the total shares that the company is having with their shareholders. That means if you are saying that a company has 200 shares and they have to share 70 naira, that means per shares, that means they are giving out 2 naira. Let's assume 9 kobo. It's not up to 3 naira. Let's assume 2 naira 9 kobo approximately. So now you that now have, don't forget that you have 10 shares now. You that has 10 shares with the company, that means that if you say 2 naira 9 kobo multiply by your 10 shares that you're having, so at the end of this periodic time, you are expected to have 29 naira. You get that? So that 29 naira they are paying you, that doesn't affect your shares. They will pay you into your account. That is what we call dividend. Dividend is like a return that the company give in appreciating their shareholders. Like I've put here that, portion of a company's profit share with shareholders, provide regular income in addition to price growth. The third aspect why you can buy shares is as a result of bonus or right issue. This place, I'm going to really take a little time to explain it because it's not that complicated, but let me take my time to explain it. Let's assume an assumption again that you have 10 shares, like we've been explaining, that you have 10 shares. Now your 10 shares now, um The company, they are because it's not every company that pay dividends. It is not every company. But the company now feel like, oh, we don't pay our shareholders dividend. What can we use again to appreciate them? They now comes up with the idea of bonus and right issue. And how does this work? Let us assume that the company or the board of directors sit down and said, okay, let's give for every 3 shares, let's give out 1 shares. What happened now is that for every 3 shares that you own in a company, the company is giving you 1 share. Don't let me use 3, let me use 2 for easy calculation. Now, the company say for every, they give a report out that for every 2 shares you own, you have 1 shares. Now, what that means is that, initially I said you have just only 10 shares, right? But because of this instruction, because of this right or bonus issue given by your company that you invest your money into in time of stock of shares. Now, if you have 10 shares and they tell you that for every 2 shares you have, you are getting 1, that means at the end of the day, 2 you have 1, another 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 2 you have 1. So at the end of the day, your total shares become 15. I don't know whether it does. Okay, let me still explain like this. 10 shares divided by 2, that means you have 5. I don't know whether you're getting it. 10 shares. So at the end of the day, instead of your stock to be 10 shares, now you are having what? 5 shares. So even if there is no capital appreciation, there is no dividend, you bought the shares at the rate of 1 naira and the stock doesn't move. Now, because of the right issue they are giving you, initially the value of the stock you have amounts to 10 naira. But because of the right issue they are giving to you, automatically your shares value now increase to what we call 15 naira. Because if you multiply 15 shares that you are having now with the 1 naira, that means that your total shares value is now 15 naira. I don't know whether you are getting it. That's the logic. So if you buy shares, you must try as much as possible to know the kind of, that's the reason why it's good to make research about the company you are trying to push your money into. There are some companies that they are well known for capital appreciation. There are some companies they are well known for dividend because their dividend yield is very high. There are some companies that people know them for that what they do is that they issued a bonus and right issue. I don't know whether you are getting it. So I'm just going to give you this for more understanding. Like now, see, understanding shares. Investing in shares works. You invest in a company. I want to highlight something. You invest in a company, right? So they are using that money to, they are using that the company is raising a shares, right? So this is the stock market that you buy from, a platform where you buy. Then what you gain as a result of investing is what we call capital growth or dividend or right issue. So those are the things you gain. And what to consider when buying this, you have to consider one, the company performance, the industry look. Which industry are you investing into? You have to consider, you have to consider the financial strength of that company. It is very important to consider that what is their financial strength of that company. And also you have to consider what we call the price value. What is the price as at the time? There are some stock that it is don't even bother buying it. And also you have to understand the risk that is attached to it. If you understand this, you understand stock market. Believe what I'm telling you. If you can understand this risk, you understand stock market, and you will really lose your money, believe me. So for your learning again, find research and know the company performance. Also know the industry outlook. There are different industries. We have what's it called, we have industry that pertains to hospitality, we have industry that pertains to telecommunication, we have agriculture. We have different industry out there. We have power. There are a lot of, we have oil and gas. There are a lot of industry. So know their financial strength, know their price value, and know the risk attached to it. So we are going into the second aspect of this. When we are talking about bonds, what we are talking about is that you are loaning out your money, most especially to governments. Like you are borrowing your money, you are borrowing government your money. But does that mean that the private organization doesn't have this also? They have, but they call it another name. Yes, it is called commercial paper. Yes. So commercial paper is still as a result of using this platform for private institution to raise capital. I don't know whether you are getting it. So government use bonds to raise money to carry out their own activities. Private sectors also use what we call commercial paper in order to raise capital for their business. You know, what's it called? A private organization now might want to how will I put it, scale up, might want to scale up their business, but at this time when it comes to capital they don't have it. So what they do is that they issue out commercial paper for the public buy. Then there are some things that is also, it works hand in hand. The way bond works is also the way commercial paper works. So that's the reason why I don't even bother to put it there. So I'm just going to explain it together, and also what are the things you have to consider. So bond, what's a bond or commercial paper structure? The thing is that you have to know that you are investing. Firstly, have that at the back of your mind. You know, we are talking about investment now, sure. So you are investing your money. The second thing that you must know, this is number one. The second thing you must know is what we call the interest rate. Now, for every bond that is being issued out there, or better still, let me even give you some example of, as it comes to my head, some example of bonds that we have there. We have FGN savings bond. That means Federal Government of Nigeria savings bond, and this is issued out every month. So you can start as low as I don't know, but I think as low as 1,000. Yes, you can start as low as 1,000. Depends on your brokers. So the thing is that you, for every time that government is pushing out this what we call bonds, there's always what we call interest rate attached to it. That means for every of my 1 million I'm investing, what am I getting in return? Government can tell you 12%, 12.5%. They can depends on the time, because yes, it depends on the time. So the first thing you must know, also the second thing you must know, is that there is interest rate. Find out what is the interest rate. And the third thing now is what we call time period. That is time allotted. Now, you are not expecting me that is giving out my money for 3 years to get the same return that you are giving the money for 2 years. It is not possible. So for the interest rate differs based on the time allotted. So if I'm investing in 3 years now, the interest I'm going to be getting will be different from you that you are investing in 2 years. So you must check the period, the time allotted to this, which is number what? Number 3. And this one now, you need to know your total returns. You have to know your total return. There is a way to calculate that. You have to know your total returns on this investment, which is number what? Number 4. Now, what are the things you have to consider? You need to consider some things sorry, you need to consider some things from this, what we call, eh, okay, you need to consider some things from this investing. What are the things you have to consider when you are investing in bonds? One of it is that, what is the purpose of that bond? I will be interchanging either bonds or commercial paper. Why? What is the purpose for government or the company issue out their own, what we call CP, commercial paper? Why? Find out the purpose, right? Also, what is the issuer reputation? Yes. Hey, I'm laughing because you don't see, this thing is very important. You don't go and put your money in a place that you will never see capital, you never see your interest. So find out the reputation. You know, there are some reputable industry institution. You know, they are, when, like government now. You know, if you invest in government won't take away, will not run away with your money now. So you need to find out their reputation also. Also, you need to find out their interest rates. That CP, which is commercial paper, or the bonds you are going into, find out what is the interest rate. You need to find out the interest rate. And also, what is the investment duration? Find out the investment duration. Duration means the time in which we've already explained here. And what is the tax implication? Now, if you invest in FGN savings bond, for now, I don't think there's any tax allotted to it. That means it is tax exempted. So you are not paying tax. Even if you invest in treasury bill, you are not paying tax because you are borrowing government money. It will be non-professional for government to still withhold or remove your money for any tax. So you are not paying tax. Well, if it is your commercial paper, you are paying what we call withholding tax. You are paying withholding tax on it. So that means the government will charge you tax on the interest on your investment, not on your capital. So what happened is that at the end of all these activities, what happened is that after your time, they will pay you back your what? Your capital, which is your investment. You know, you are borrowing them money for a specific period. Then after that time, they will pay you back your investment fee. Is it clear? If you have any question, you can send your question on the comment section.